Assalamualaikum and welcome back. Hi everyone, this is the second video, which is the second part of the session on how to prepare the consolidated statement of profit or loss and other comprehensive income for a simple group structure. This is MME Berhad and its subsidiary LO Berhad for the year ended 31st December 2017, and this is a practice question for preparation, and I'm taking this question from the FAR320, that is question 3 June 2018. Acquisition of the subsidiary in this situation involved the acquisition during the current year, where the post acquisition in the current year was just 6 months since the acquisition was on 1st of July 2017. If you are interested and you want to learn more on the preparation, please go and check my first video. This is the second one, so start with the first one, then only continue with this one. So I'm going to continue it here, and let's look at the next one, which is the one related to item that you have here, that is the item investment income. So the investment income that you need to consolidate is the one of the parent with the one of the subsidiary. Remember, the one of the subsidiary will have to be time apportioned. So let's look at this first, and we need to also eliminate the intercompany transaction, if there is any. In our case, there is an intercompany transaction, and that before we do that, we just do the one of the parent, add the one of the parent to the portion that parent has shared in the one of the subsidiary, 6/12, and you consolidate them. The aggregate amount will be shown, but you need to go and adjust with the intercompany transaction. So the intercompany dividends that you need to remove is 5,200. Earlier we have done the adjustment here, which is what you have done here. Debit investment income in the SOPL, credit dividend receivable. The total will be the total from these two. You have 5450, but I'm doing it as a split figure. First, I'm doing for intercompany order dividends. I remove, and I'm also removing the my item here is my intercompany preference dividend. Next is to after you have done the removal, now you can now report the group dividend, which is the dividend income. This is the investment income that represent the one of the group. Right. Next one, we go to the next part. That was the one that you have here in the line item here. I'm going to do the operating expenses. There are a few operating expenses that we have already identified that would have affected the operating expense. The first one, I go by the order. Information number 2 and number 3. Before that, we need to go and report the consolidated figure. The one of the subsidiary is time apportioned for the 6 months during the post-acquisition period. And now we're going to adjust for the over provision. Over provision is the one that had taken place during this revaluation surplus in number 2 here. So there was an over provision of 100,000. So when under provision, so that under provision would have been debited to the expense, which is depreciation expense, and that would increase the operating expense. The amount was 100. And there's another one, amortization. The amortization here is the amortization of the customer lease that was being recognized. We have done that much earlier. If you can check in my first video, that was the one in number 3, and the amortization was 1.58 million. So 1.58 million has not been provided, and now the asset is being fair valued, and you incorporate that. So therefore it was amortized over 5 years, and you need to go and multiply by the post acquisition period as well, since amortization has taken place, right? Next is for us to look at the next item on goodwill. and also information number 6. For goodwill, there was an impairment. So the impairment of goodwill, I'm doing it here. So I show you the goodwill impairment here for you. So the goodwill has been credited, and the impairment loss is charged in operating expense, and the impairment has to be incorporated there, charged as an expense, and the amount was 2.8. Then there's another one here that was relating to the gain, intercompany gain on disposal that you have identified earlier here. You need to also do adjustment for the over provision of depreciation. We have earlier calculated that in our first video, and the amount was 2049.775. You have this here, this figure. And the over provision is what you need to reduce the expenses, because you go and credit the expense, right? So you reduce it, so that is actually being deducted again the expense, since it has been over provided. So now you have the figure there for your item, which is the total operating expense. You can now put your profit before tax and the taxation figure together, and I'm going to show it here, where that would be, this figure should be time a portion, nothing else, and now you have the profit after tax to be 90. The taxation was 9950, and the profit would be 248,620,675, which is profit after tax, also known as profit for the year. So now let's look at how much is the share of the profit after tax or profit for the year, or for the subsidiary, for the subsidiary company. So let's do that. Let's do that. Okay, so first put the profit for the year. This is taken from the question here, the subsidiaries part, and you need to time a portion. Remember the post acquisition period. This is done only for acquisition during the current year. So the post acquisition period was 6 months. We time a portion them. So when we time a portion, what you show is the 6/12 time period, and that will give you 71,950. Then you need to make adjustment to the profit of the subsidiary for those items that had not been reflected, and this one is adjustment to the current year. So the first one is unrealized profit, where I've put these notes here, that the unrealized profit that arose in the subsidiaries profit for the year, so therefore it has to be reflected and shown for the adjustment of the share of the non-controlling interest. So we need to show it here. So it's the same thing that you need to show the amount that you earlier had done here, this one. Okay, next is the information on current year depreciation that has been under provided for the revaluation that took place here, and that was 100, or that was the surplus, and revaluation has taken place before that on the date of acquisition. Another one is the fair value adjustment. Fair value adjustment needs you to also adjust the amortization, and these are done in the subsidiaries profit, and therefore what you have here is again what you have calculated earlier, 1580. And the last one here would be to look if there is any preference dividend. So here you have the preference dividend in the subsidiary. You are not informed what is the rate, but since you are not given, so you just take the preference dividend in the subsidiary company, this one. And you need to go and check what is the share of the parent, share of the non-controlling interest in that dividend. It was 80%, and then to find out how much is the profit attributable to the non-controlling ordinary shareholder. It was 20% based on this percentage and this percentage, right? Therefore, that was non-controlling interest for the ordinary shares. You will have 13,144, and the figure 14,144 is the one that will be shown as the amount attributable to the non-controlling interest here. And therefore, the one attributable to the parent would be the difference between the figure 248 million 620 and 675,000. Here, the one here should be the difference, and that difference would be the amount attributable to the parent. Now you proceed with the statement of changes in equity. First, I would suggest you to put those figure here, which is at the profit for the year. Take that figure that you earlier calculated, which is the figure here, and also the non-controlling interest that you just calculated, the one here. Okay, right. Oh, that's a different color here. This is okay. Now we have to find out what are the retained profit at the beginning of the year. We just follow the format that you have here. Start with the retained profit, and we are doing the column for the retained profit as well as non-controlling interest, the one at the beginning of the year. Okay, for your information, since you acquired the subsidiary on 1st of July 2017, the group retained profit that you are going to calculate will not include the retained profit of the subsidiary. Why? Because on that date, 1st of January, it does not the retained profit of the subsidiary has not been part of the group yet. So what you need to do is you just need to take this figure, and there is no need for you to go and add the one of the subsidiary, because the subsidiary has not been acquired, and therefore there is no share of the parent. Those are all pre-acquisition profit. So just take the one of the parent. I've put here a note H only, which refers to the holding company, as all subsidiaries retained profit brought forward is in the pre-acquisition period. Right. Next, we don't also have the non-controlling interest brought forward on 1st of July. Why? That was because on 1st of July, the 1st of January, it was not yet being acquired. The acquisition of the subsidiary only took place on 1st of July 2017. So here it will be 0. And therefore, you need to find out what are the non-controlling interests on the date of the acquisition. So acquisition on, let's say here it was 1st of July 2017. What was the non-controlling interest amount on the date of acquisition in the current year? So let's find out. I've already prepared the workings here. First, you need to find out how much is the preference shares, the non-controlling interest coming from the preference shares. That was preference shares of the subsidiary, 200,000. Where is the 200,000? The 200,000 is the one that you have been informed here in the subsidiaries information. 200,000. 200 million actually, 200 million of preference shares, and we multiply with 1 ringgit, you have 200,000 ringgit, and this is not in units, this is actually the amount, 200 million. So I add up. Yep, that was the working, and therefore 200 million times 80%, so it will give you 160 million. Now you need to find out the fair value of the net asset on the date, of acquisition here, since this is during the current year. Acquisition is during the current year. Take note that we are looking at the date 1st of July. which is during the current year. So bear in mind and remember that. Next, so we are going to show the first item, which is the share capital on that date. And then you have the item general reserve. So that, where do I get that? It is here. It was here. These were given here. The amount 275,950 and 56.5. Even if the amount 275,950 is not given, we can still calculate that. I will show you in a short while. Next, that not need to be calculated. So the general reserve we include there. For the information number 2, and information number 3, I include that first because that involves the creation of the asset revaluation reserve, the surplus that was arising on the day of acquisition, as well as the customer lease that has been fair valued, and that was 15 million to be the um, figure. And now the information 1 just now mentioned about the retained profit, it was given. So you now can total up the figure. If you total up, you will get 85850 250. And if you do that, you will go and multiply that with 20%, since the percentage of non-controlling interest in ordinary shares was 20%. That will give you 1,017,050, and here would be 330,050 million, and this must be shown here. Okay, so alternatively you can find it this way. You can check what I'm highlighting here. You can do this way to find the same figure that was given in the question. So you can check this yourself, but since the question has given you, if the question does not give you, this is how you get the figure that was given, which is the retained profit on the date of acquisition during the current year. You can use the retained profit brought forward and go and add up with the pre-acquisition amount so that you can find what was the profit that stood in the company um, on the date of acquisition. But bear in mind to go and apportion them according to 6 months for the current, for the profit for the year. So you get the retained profit on the date of acquisition. So you have done that. We now look at the appropriation part. In this question, we do not have any other comprehensive income, since those other comprehensive income, even if you have here the surplus, you can see here there was a surplus, but this was the one that arise on the date of acquisition. So it will not be reflected in the fair value of net asset, because it so in the consolidated statement, in the statement of profit or loss, under other comprehensive income, since that was during the date of acquisition, pre-acquisition surplus for both situations. So now we go and do things for subsidiary, for parent, which is much easier. So for the parent, if you can go to the statement of changes in equity, you can see that I just simply take the one that were here straight away, transfer to the general reserve. There was none of the subsidiary. Ordinary dividend paid, just the parent only. This is the one that were declared by parent. Right? The ordinary dividend by parent, ordinary dividend by the so-called parent. And here, if you see dividend here, 6,500. If you are informed much earlier, it was all declared during the post-acquisition period on this somewhere December 2017. We settled that first. Now we move on to the one of the subsidiary. Remember, this one is the column for parent dividend distribution. Same goes for the dividend for the ordinary shares. There were no transfer to the reserve made by the subsidiary. If there is any transfer, parent may have a share of that transfer here, but here none, no transfer. Then we go on to the subsidiary. So we are done with the column retained profit. You should get 434,076,675, which is actually the profit that you have here, the amount that you have here, which is a balance brought forward plus acquisition of plus the profit for the year. You have the profit to be distributable to the shareholders. And the next one is You have the one of the dividend that relates to the non-controlling interest. The first one is the preference dividend. Remember, the preference shares has 80% non-controlling interest, and the one relating to the ordinary shareholder. Bear in mind again the non-controlling interest percentage don't get mixed up, and don't forget that post-acquisition dividend were paid in December. That's why the non-controlling interest portion must be reflected as it is, and that was in December. Done with that? We are done. So that's it. That's the preparation of consolidated statement of profit or loss, and together with this consolidated statement of changes in equity, focusing on this section of the non-controlling interest and the retained profit only, right? And this is a preparation for the acquisition during the current year. So you can also read all this little note here, what I have written here. Why do we need to remove, for example? These are all some notes to help you, as well as the bottom here you have why you remove the amortization from the profit, why you charge, for example. These are all to read do the consolidation adjustment. With that, thank you for watching. I'll see you in other time in the next video, and all the best, and I'll see you again next time. I'll see you, and I'll see you. Assalamu alaikum, and have a pleasant day ahead. Bye bye.